Good morning. First of all, let me thank all of you for listening in today. My name is Ignacio Ponce de Leon. I'm the Chief Operating Officer of Clean Coal Technologies, Inc., a New York-based company trading under the ticker CCTC. We're trading on the OTC QB, and we've been public since 2007. Our market cap is about $33 billion. We're a debt-free company. The focus of our company at present is the rollout of a portfolio of technologies that will help make coal an environmentally sustainable fuel. Coal is not a sustainable fuel at present, so needless to say, a clean tech solution in this industry would be transformational. The company that develops a viable process to upgrade coal to make it a sustainable fuel will be a multi-billion-dollar company. We believe we have a solution. Our commercial rollout is just months away in the fourth quarter of this year. Over the past year, we've secured about $18 million in equity capital, $15 million of which is a commitment from an entity called Ventrillion Management Company. Ventrillion is a Singapore-based SPV held by a high net worth individual with close ties to the top tier of Indonesia's coal industry. Of the $15 million committed, $4.4 million has been paid in, with the remaining $10.6 million to be paid in based on milestones that we expect to reach over the next 6 months. The milestones are the commissioning of our pilot plant in Oklahoma this fall, and secondly, the signing of our first commercial contract. Prior to Ventrillion, we received a $2 million investment from a company called RedChip. It's a $1 billion top-line company that holds significant reserves, coal reserves in Indonesia. The $2 million enabled us to fund the initial stages of our pilot plant. And finally, last year we granted a 25-year technology license to Jindal Steel and Power. Jindal is part of the 18 billion Jindal Group and one of India's largest steel and power producers. Like many of Asia's largest transnationals, Jindal is seeking to secure long-term supplies of thermal coal, and to that end, it's acquired significant reserves in South Africa and Indonesia that need to be upgraded. Following their due diligence, Jindal paid us 50% of the $750,000 license fee. The second 50% will be payable when the pilot plant is commissioned. We expect to move quickly into commercial mode with Jindal once the pilot plant is commissioned, thereby triggering the final installment of the Ventrillion commitment, which should see us through commercial revenues. Our funding needs are interim, pending the meeting of milestones. Now, for the time being, our business model is simple. We're a technology licensor, and we collect license fees and royalties. The engineering and construction of CCTI plants is performed by outside EPC companies under direct contract between them and the companies that need to upgrade the coal. Given this, our business model is one of very low fixed costs. Our cash burn is very small in the $3 million per annum range and expected to rise only modestly. Now, quickly on management. Our CEO, Mr. Robin Eves, is a 30-year veteran of the energy business. He has headed up global oil trading for Cargill, the pre-1992 Enron, and for UBS. He has significant deal experience in Asia, Europe, the Middle East, the Americas, Russia, and Africa. He's worked out of several countries around the world over the past 30 years and brings great contacts and credibility to the company. I'm a Wall Street veteran. My last major position was with JP Morgan, where I founded, and for 12 years, I managed the firm's global fixed income research effort focused on emerging markets corporations, including Latin America, emerging Asia, and emerging Europe. My team was was first or second in the Institutional Investor All-America rankings and the Euromoney rankings for several years, and supported what is probably the largest EM capital markets and trading business in the world. I was an M&A banker for 6 years and covered engineering, construction, and construction stocks at Credit Suisse First Boston. Our non-executive chairman, Dr. Edward Jennings, is twice former president of the Ohio State University and also the University of Wyoming. He has vast overseas business experience and holds a PhD in finance from the University of Michigan. Beyond these key individuals, we have on retainer some very, very prominent, highly experienced consultants that bring over 30 years experience on the engineering side of the industry. Okay, now let me now turn to the investment opportunity we're bringing today. First and foremost, it's an exceptional risk-reward opportunity. As you will appreciate after we go through the presentation, we believe that a 10 to 20 time expansion of our market cap is likely, supported by good earnings visibility kicking in through 2014. The opportunity for our company to become a market leader is hardly a stretch. Our technology, in our opinion, and that of highly qualified experts, is already best of breed. The macroeconomic drivers of our business are strong and stable, pointing to a growing consumption of coal for many years to come. This, of course, makes indispensable technologies to improve the sustainability of coal. Finally, as will be clear by the end of the presentation, you will understand that the reasons of the cost and the need for a secure base load power, coal will not be displaced by other fuels. The market opportunity, or the addressable market, is in the hundreds of millions of tons. So let me just mention some of the macro aspects here. The big picture is that global coal consumption grew from 5.3 billion to 8.1 billion tons. That's that's a 3 billion ton or 54% increase in annual consumption between 2000 and 2011. Almost the entire increase was concentrated in developing Asia, primarily India and China. Most of the coal was consumed by the power industry. Now, taken as a whole, the IMF reports that the developing Asia's GDP in 2011 was 141% higher than it was in the year 2000. In contrast, developed markets' GDP was only 17% higher in 2011 than it was in 2000. To us, the prodigious increase in output and productivity looks very much like a second industrial revolution. The growth of output and the pace of growth even exceed what took place in the Western economies in the 19th and 20th centuries. Starting from a low base, just as one example, in less than a generation, China's takeoff may or likely will result in it surpassing the US economy as the largest in the world. Before China, countries like South Korea experienced takeoffs resulting in extraordinary increases in output and productivity that continue to this day. Now, owing to the degree of urbanization, the penetration of information and communications technologies, higher education, savings rates, and the existence of domestic capital markets, we believe firmly that the long-term growth trends are sustainable. To support it, in the case of India and China, each have plans to double the capacity of their power sectors within a decade. Today, China is adding a power plant per week, most of them coal-fired. Now, one last metric. In 2010, US annual per capita consumption, as electric power consumption, stood at 13,400 kilowatt hour. In Australia, it stood at 10,300 kilowatt hour. In contrast, per capita consumption in China was 2944 kilowatt hour, or 1/5 the US, and in India, only 616 kilowatt hour, 1/20th the US. There's a long way to catch up. We think this gap will narrow. Now, why will coal fuel this Asian expansion? First, on a cost per unit of energy basis, coal remains among the most abundant and cheapest sources of energy. Per unit, coal costs 3 to 5 times less than oil. Energy efficiencies are high in conventional coal furnaces. They're in the 45% range. Now, by energy efficiencies, we mean the amount of usable or saleable energy that is commercially extracted from a particular fuel source. So 45% is the range for coal. So we do not envision baseload power generation to be based on fuel oil. Nuclear power, unless public opposition to it subsides, is unlikely to grow its market share. Outside the US, natural gas is very expensive. In Europe, it's two times higher than the US. In Asia, it's about 4 times higher than the US. And besides, it's not really widely available. Other than hydro, renewable energy is not a solution. Energy efficiencies remain very low, under 20%, which explains why these nascent technologies have required subsidies that in many places have now been eliminated. But the most important argument for coal is that for baseload power, security of supply is of paramount concern. Coal can be stockpiled at low cost. In fact, most coal-fired power plants stockpile a minimum of 30 days or as much as 120 days in order to avoid supply interruptions. In other words, coal is a highly reliable source of fuel for baseload power, leaving peak generation to other fuels. Now, let me just recap a couple of things so far. First, coal use is on a steady trend line rise, and we expect the trend to continue to persist. Second, coal cannot and will not be eliminated from the grid without putting baseload generation at risk. Even in the US, where natural gas has made inroads, coal's share in the fuel mix for power generation remains about 40%. It's an awful lot of power to generate with a substitute fuel, especially one that may compromise the security of baseload power. So given present and expected coal consumption, it's easy to understand that the technology priorities for the industry have come to the fore as urgent. Clearly, the world cannot continue to consume coal at this pace without dealing with the problem of air pollution that, as we all know, has reached epidemic proportions in some parts of the world. Secondly, as more and more coal is consumed, low-rank product has captured a greater share of the total consumption. By low rank, we mean high moisture coal. High moisture coal ranges from 30 to 50% moisture content. Such coal is increasing its share. Now, why is high moisture coal undesirable? First, because a lot of coal is consumed, driving off the moisture before saleable energy is produced. Think about heating a room with wet logs. The additional coal consumed, secondly, the additional coal consumed contributes to further air pollution. And third, the transportation economics are ridiculous. No one wants to ship 50% water. So, as another conclusion, the future of coal as a sustainable fuel depends critically on upgrade technologies. Okay, at this point, let me introduce one of the most important aspects of our story, our relationship with a company called SAIC. For those of you who have not heard of SAIC, let me give you the main facts. Based in McLean, Virginia, SAIC has been described as the 800-pound gorilla of U.S. science and engineering. Unlike companies like Bechtel, Dresser, and Halliburton, SAIC is a gigantic think tank. It employs over 50,000 scientists and engineers worldwide. It is currently the Fortune 240. It has a top line of about 10 billion. So just imagine a think tank with a 10 billion top line. The bulk of its business is focused on high-tech solutions for defense and intelligence. In point of fact, some 50% of their employees have security clearances. SAIC's board of directors over the years has included several secretaries of defense as well as former high-ranking individuals from the intelligence community. Its current chairman is former chief of staff of the Air Force. Beyond intelligence and defense, SAIC has significant expertise in process engineering, environmental science and solutions, and energy. In fact, it has the leading environmental science practice in the country, and SAIC has emerged as the go-to company for exceptionally complex, one-off type assignments. They take credit for many highly innovative solutions in various fields. Their engineering qualifications are second to none. For many years, SAIC ran the National Energy Technology Lab, which is the research arm of the DOE. They possess very relevant knowledge for our particular space and are familiar with many of the solutions that have entered the field before us. SAIC has been involved with our technology for over a decade. That a large cap company with a profile such as SAIC's has remained involved with a small OTC company such as ours is testament to their confidence in our technology. In point of fact, SAIC has invested considerable amount of sweat equity into our process over the years. We have a 15-year umbrella agreement designating them as the preferred EPC contractor on CCTI deployments anywhere in the world. For this, they will continue to provide engineering expertise and help us maintain our IP current. As a general statement, I feel confident to suggest that the people who today stand behind CCTI's intellectual property and technology solutions represent the best brainpower that's been brought into this segment to date. SAIC has designed and is now completing the construction of our pilot 1:15 scale industrial plant. The design is brilliant. It's met all of the challenges that stumped many of the companies that entered the technology space before us. What differentiates our process is the built-in flexibility of the design that is uniquely suited to coal, which, unbeknownst to a lot of people, is a highly variegated mineral. Coal is not a monolithic mineral. You cannot process it under same conditions and expect uniform results. Even within a single seam of coal, a sample from one part of the seam may vary significantly as to its chemical composition, its structure, and its moisture content from a sample taken from another part of the seam. Upgrading coal is a chemical process. The process parameters may be different from one coal sample to the next. The SAIC design is capable of adjusting for coal varieties in a highly automated continuous process. Finally, based on a site agreement that's been negotiated with the Fortune 150 U.S. power company, our test unit is to be located at a coal-fired plant in Oklahoma that is owned and operated by the utility. Our agreement includes concessional terms for a commercial license. So now let me just turn to the value proposition. There are a couple of slides in the slide deck that you can look at. I'm not going to go through the plant economics slide, except to mention that it's based on actual test results on Indonesian coal. The slide refers to one of our processes, namely the Pristine M, which is the one designed to drive the moisture out of low-rank coal. In our business, this is the low-hanging fruit, as the Asian producers are desperately seeking a solution, and there's a large and immediate market opportunity. What the analysis shows is that our upgrade process for that particular low-rank coal is able to add an incremental value of about $22 per ton. So based on a $50 million investment in a 1 million ton per annum plant, the upgrade results in a return on equity, this is unlevered return, of over 35% and an investment recovery period of under 3 years. These plant economics are very compelling, and as is shown, they include a $3 per ton royalty for CCTI. We've put in a $3 royalty for illustration purposes, but let me mention that some of the companies that have come before us have charged well north of the $3. For us, this is just an illustration. Now, turning to the risk-reward analysis. I mentioned earlier that coal consumption reached over 8 billion tons per annum in 2011, and that it's on a steady rise. So if only 10% of the coal consumed were upgraded, and the addressable market would be 800 to 900 million tons per annum. In fact, we believe that well more than 10% needs to be upgraded. A lot more needs to be upgraded. So of that, of the 8 to 900 million, if CCTI with its cutting edge process were to capture a 2 to 3% market share, we would establish an annuity base of about 25 million tons. Now note that with our share established, industry penetration would remain well under 5%. By necessity, industry penetration will need to be far greater, far greater. Now, if you look at the valuation slide, a 25 million ton base and a $3 royalty would result in an annuity stream of about 75 million per annum for CCTI, which capitalized at 10% would result in an intrinsic value of about 720 million, or 20 times our current market value. 25 million tons is an achievable target, making this an extraordinary risk-reward opportunity that at this point has been greatly de-risked, given where we are in the development and rollout of the technology and the credibility of the engineering and partnerships already established at CCTI. So just finally to recap, small as we are, CCTI is contractually associated with several powerful companies. SAIC, ranked Fortune 240 and a leader in U.S. science and engineering, Jindal Steel and Power, an $18 billion Asian transnational waiting to deploy our process commercially, Ventrillion, closely associated with the powerful coal companies in Indonesia, and a major utility, Fortune 150, that's allowed us to locate our 2-ton-hour plant at one of their facilities. I should mention that the utility operates in about 25 countries outside the United States. We're looking at commercialization in a space of 6 months, and we are convinced that our technology is cutting edge. With this, I thank all of you for your interest.